Hey guys, so today I wanted to make a video talking about ETFs and the different ones that are out there. So I wanted to start out with VT, and VT is Vanguard Total World Stock ETF. So when you're looking at these ETFs, for example, if you're looking at it on Webull, you could just click this tab right here. It says Show, and then what I like to look at is just this Analysis tab right here. And we could go into the top 10 holdings. So in this ETF, now for those of you who don't know what an ETF actually is, it's a basically a basket of stocks. And what you're buying is a ticker that is holding all of these companies. So when we're looking at the top 10 holdings, this is what VT is holding. Their top holding is Apple, followed by Microsoft, Amazon, Tesla, Alphabet, Meta, Nvidia, United Health, and JP and Chase. So you could tell that this is pretty tech heavy. So this is mostly what I would say a tech ETF, just based off their top 10 holdings. So always keep that in mind. I mean, if you're bullish on tech, then yeah, this is something that you're going to want to own. Now, I also want to point out some other stuff. Here on this performance tab, you can see how they've been performing. So you can see over the last 6 months, they haven't been performing too well. But then you go out here and you look since inception, and then since 10 years, 5 years, 3 years, 1 year, it's been performing pretty well. Now, to get more information on this, we can go on Yahoo Finance. We could type in VT. And then here we're going to get a little bit more information. So you're going to get the yield. Now the yield is talking about the dividend. So this is the yield that we're going to get. We're going to get 1.65%. But the yield is something that changes all the time. And I'm going to show you how you actually calculate the yield. So let's see. Right here, there's also something called the expense ratio. Now, these ETFs, they have employees and they're doing all sorts of things to manage this fund. So us as investors are going to have to pay them some sort of fee. And the fee is basically 0.08%. And this isn't an upfront fee. You're not going to see this fee show up in your account or whatever. This is basically they're scalping the dividend. So when they pay you out these dividends, they're just paying you a little bit less than what you would normally receive if you were just owning the exact same shares of this company in a basket that's not from a traditional ETF. So this 0.08, it's very, very little. It's very minute. And you're never actually going to see the actual expense because they're just scalping it from their dividends before they hand that dividend to you. So now I'm going to show you a dividend calculation. So right here in this performance tab, we can also go into the dividend history. Now, this is showing you the dividend payout every quarter. And as you can see, it really varies. So I don't really know what accounts for all of this variance, but you can see that over the last few years, the dividend literally just goes all over the place. So let's calculate the last year of dividends. So what I'm going to do is I'm going to add up the last 4 quarters, and then we'll see what that dividend payout is. So starting with this one, we're going to add 0.785, and then we're going to add 0.412 plus 0.505 plus 0.253. Now, this is about a dividend of 1.96. Now, the way that we're going to calculate the yield is we're going to divide this dividend by the actual share price right here. So that's 1.955, and then we're going to divide that by 94.66. Now we're going to multiply this by 100. So here we see that we have a dividend of 2.065. And then as you can see, if we go to the Yahoo Finance, we see right here that it says the yield is 1.65. So you can see some variance. And the dividend yield is something that changes all the time because remember, we're basing this off the actual calculation right here from the stock price. So if we wanted to actually get a better representation of the dividend yield, what we could actually do is we could calculate this ourselves. So we could get a sample, we could maybe get like 5 years worth of data, and we could calculate an average of the dividend. And then we could create the dividend yield that way. So since I showed you how to do this, you can actually go and do it yourselves to get a better feeling of what the actual dividend yield is. Because as you can see, what we just calculated now is completely different than what you see on Yahoo Finance. Now, let's go on to the next one. This is a VIG, Vanguard Dividend Appreciation ETF. And we're going to look at some of the same stuff here. So we're going to look at the performance. And we could see it's been performing pretty well. Now let's actually compare this to VT. So when we look at VT, we see this 5.45 and then 45% right here. We see 12.93, 52.79. So it's actually been performing much better. Notice it's called Appreciation ETF. So in my opinion, this one would be a little bit better to own just because the share price appreciation is higher. It's been performing better. As you can see, we could compare the stats right there. Now let's go on Yahoo Finance. Let's look at VT. And then right here, we can see that the expense ratio is 0.08. Or actually, no, I meant VIG, V-I-G. So we can see right here, the expense ratio is 0.06. So it actually has a better expense ratio than VT, which was 0.08. And then let's just do the same thing with the dividend here. Let's go into the dividend history. And then let's just calculate the last 4 quarters. So 0.772 plus 0.6999. Oh, oops, whatever, it's so small. Plus 0.675 plus 0.5131. Now that's 2.66. So that's $2.66 for every 1 share you own. And this is just the last 4 quarters. And we're going to divide that by the current price right here, 153.44. And then we're going to multiply that by 100. So here you see that the dividend yield is 1.73%. Now, we already saw that the share price appreciation is higher for VIG, but the dividend for VT is actually higher because the dividend that we calculated was about 2%ish, it was a little over 2%. So the dividend from VT is actually better than VIG, but the VIG share price appreciation is better. So there's always these things that you got to weigh out. It's never just, oh, well, one is perfectly better than the other. VT pays a higher dividend than VIG, but VIG has higher share price appreciation. Now we're going to look at the same thing with the analysis tab and the top 10 holdings. So here we can see that Microsoft is their highest holding, followed by United Health, Johnson & Johnson, Home Depot, JPM, Procter & Gamble, Visa, Broadcom, and Accenture and Costco. So you can see that VIG is much better diversified. So I think that this is probably a ETF that could weather the storm a little bit better. Now let's look at VYM. This is Vanguard High Dividend Yield ETF. So we're going to do the same thing. We're going to look at the performance. And you can see that this has barely gone down. So it looks like Vanguard High Yield or High Dividend Yield ETF can definitely weather some storms. Now we're going to compare this with all the others. So you can see that VT is suffering pretty badly these last few months. VIG is also suffering a little bit. VYM, on the other hand, is barely down. So you can see people run to this one in times of uncertainty. And why is it called the high dividend yield? We'll actually calculate that right now. So let's do the same thing. We're going to get the last 4 quarters here. So 0.9386 plus 0.7488 plus 0.7523 plus 0.6564. So altogether in these last 4 quarters, they paid out $3.09 per share. And then we're going to divide that by 108.38. Now you can see that the dividend yield is pretty darn high. It's 2.85%. And it's barely seen any, it's barely got a cut from these last few months as we look at the performance. So here, this one might be a really good one to own when there's a lot of uncertainty because people are going to be running to these safer dividend stocks. So let's just look at the companies that they own, top 10 holdings. Now you see that they have JPM, Johnson & Johnson, Home Depot, Procter & Gamble, Pfizer, Bank of America, Cisco, Broadcom, Exxon, PepsiCo. So they have a little bit of everything here. Let's take a look at their expense ratio. Now that was VYM. So expense ratio right here is 0.06%. So that's not bad at all. Let's just write that down, 2.85%. Now let's move on to the next one. So SPY, the one that everybody knows. Now let's go and look at the performance. You can see it hasn't been performing well these last few months. But if we look at the 1 year and the 3 year, my God, it's been performing extraordinarily well. Let's just compare that with VYM. Now, the thing about VYM is that it might not be hurting that much right now, but you can see that the performance isn't as high as SPY. So right here, 1 year we see about 17%. 3 years we see about 40%. So here you see about 12% and 61%. And then if we go back 5 years, it's almost 100%. So let's just go back 5 years here. It's only 63%. So these are the things you have to look at when you look at an ETF. You know, it's not always just buy this one because of this. It's buy this one because of X, Y, Z. There's plenty of reasons. So we're looking at SPY. Let's look at their dividend history. Let's do the same thing. Let's calculate And I'm making a habit out of doing this because I really want you guys to be calculating your own dividend yield. You don't want to just look it up on Yahoo Finance or whatever, because this is something that you could be tracking all the time. Because remember, dividend yield includes the actual share price, which is constantly changing. So here we're going to calculate the last 4 quarters again. And I know it seems kind of tedious, but I'm going to do this through every single ticker. So 1.6364 plus 1.4281 plus 1.3759 plus 1.2778 equals, divide that by 420.07, multiply that by 100. So our dividend yield here is 1.36. And then we saw the performance. Now we're going to go here to analysis, top 10 holdings. You can see Apple, Microsoft, Amazon, Tesla, Alphabet, Meta, Nvidia, Berkshire, United Health. So almost all tech is the top 10 holdings. So keep that in mind. Right now, SPY is hurting a lot because tech is hurting a lot. So we're going to go right here. We're going to look up SPY, and then we'll see their expense ratio. Now you see that SPY expense ratio is 0.09. So it's a little bit higher than the rest. And then now we are going to go to QQQ, which follows the NASDAQ. So we're going to look at performance. And here, this is showing a different story. So let's compare SPY and QQQ. So now in terms of performance, you can see the last few months have been terrible. Now let's go back 1 year, 3 years, and 5 years. So if we go back 5 years, it's 171%. If we go back 5 years here, it's about 97%. So you can see that QQQ is definitely a higher performer because over the past few years, it's been performing better. It's as simple as that. Now let's go over and look at dividend history and look at the dividend yield. So let's go ahead and calculate this again. That's 0.49 plus 0.41 plus 0.39 plus 0.39 equals, divide that by 324.4 times that by 100. So you can see that the dividend yield here is very, very small. So it's a fraction of a percent. That's 0.517%. And you can see why. Because the NASDAQ is such a high performer that they're not actually paying as much dividends here. And just think about the stocks that comprise this, which we're going to look up. It's mostly tech, and tech doesn't pay that much dividends. Whereas some of the other stocks, or some of the other ETFs, they were holding a lot of healthcare and a lot of oil companies, which pay much better dividends. So here we see Apple, Microsoft, Amazon, Meta, Tesla, Nvidia, Alphabet, Broadcom, Adobe. And then let's go over here. Let's look up QQQ. We could see the expense ratio is 0.2%. So this is definitely the highest expense ratio out of the group that I mentioned. So now I want to point out one very, very important thing between QQQ, SPY, and the rest of these. So let's go and start with VT. Let's look at the options. So you can see that the options only go out a few months. It goes all the way up to August 22. So here we don't have as many options. So Vanguard Total wouldn't be as beneficial to own 100 shares. Now VIG is the same deal. We're going to look at the options, and it only goes out to August 22 as well. VYM, same deal, except it actually goes out a little bit further. It goes all the way out to October. But now let's look at SPY. SPY literally has options for every 2 days. So if you want to own 100 shares of something, SPY would definitely be the better option if you want to own 100 shares. Because if you own 100 shares of SPY, then you could do something cool. You know, you could sell a covered call. And then same with NASDAQ. If we're looking here at NASDAQ and we're looking at options, it goes every 2 days. So now let me just show you guys what I mean by covered calls. So this is going to be a very, very brief explanation, and it may not be clear to you if you don't know anything about options. So I'm making the assumption that you do know a little bit about options. So let's say I own 100 shares of QQQ at this current price of 324. So 100 shares, 324.40. Now, I want to protect myself from downside, and I think that the stock market is going to fall a little bit between now and March 18th. So on March 18th, I'm going to sell a covered call, and here's what I'm going to want to do. I don't really want to sell my shares, but I just want to protect myself from the downside. So let's say, for example, I'm not telling you to do this. So for example, I want to sell the 329 strike call for March 18th. So how much premium is attached to that? Well, it's about $4.55 per share. So that's about $455 if you own 100 shares. So that means if QQQ is below 329 by March 18th, I pocket all of this premium from the covered call. And a covered call is basically I'm selling a call. So people will call this writing a call. I'm selling a call. So now let's look at the other situation. Let's say that QQQ is above 329 by March 18th, and I haven't gotten rid of this call option that I sold. So if that's the case, I have to sell my 100 shares at 329. But is that necessarily a bad deal for me? Well, not really if I bought 100 shares at 324, because what happened is that I made about $500, so $460 to be exact. I made $460 just on selling the 100 shares at 329. Plus, I made another additional $450 in premium. So that's not exactly a bad situation to be in. So now, this doesn't mean that you have to just sit there and do nothing and let your shares get sold. So, for example, if NASDAQ just jumps up the next day to 326, and I say, uh-oh, I think I might get called out, meaning I might have to sell my shares. Then what I could do instead is I could buy back the contract that I sold, and I could pay more than the premium that I sold it for, which means that I would have to take a loss. So I would take a little bit of loss to hold that 100 shares. So this is what having 100 shares does for you when you hold these ETFs, because then you could sell things like covered calls. And the benefit of owning QQQ and SPY is that you could do this in basically every 2-day intervals. So you can see in SPY, we have the same options. So you could hedge yourself a lot better if you own these ETFs, the SPY and the QQQ. But as you notice, the dividend payout isn't as great. And then we look over here, you can only hedge yourself a few months out at a time. So this is what I have to say about dividends and ETFs. And I hope you guys really enjoyed this video. And I know that a lot of these companies, like Tesla and everything, I know that these are all exciting, but there's a lot of risk attached to them. And owning a company through an ETF could be a much less risky way. So I hope you guys enjoyed this video. And I do hope that you come around to ETFs if you're not